It is no longer news that people are trying to get onto the property ladder. And I've been getting a lot of questions about how long do I have to be in the UK before buying my first house? Or do I even need an indefinite leave to remain or citizenship? Some people are even asking, do I need like £50,000 or how much do I have to have in my bank account before I can be eligible to buy a house? A lot of questions have been going around. Anyway, the good news is you can buy your first property regardless of your status, either you are as an immigrant or as a citizen of the country. And this video, I will be telling you 5 things I wish I'd known before purchasing my first property in the UK. If you think this video will interest you, please keep watching, like, share, and subscribe. I will appreciate it. Before I get into the video, I think I should debunk the myth going around about you needing to have an indefinite leave to remain before you can be eligible to buy your first property. I think that is totally not correct. I bought my first property without having an indefinite leave to remain, and so many other people did. So first and foremost, it is important that you understand the mortgage market. Now, this includes mortgage rates, mortgage eligibility, and affordability assessment. So talking of mortgage rates, oftentimes there are 3 general rates that people tend to go on when they are getting the mortgage. These are fixed rates, variable rates, or tracker rates. Now, for fixed rates, you tend to pay a particular amount of interest over a specific period of time, which could be 2 years, 5 years, or 10 years, depending on the agreement you have with your lender. And when I mean lender, I mean the bank that you're getting the mortgage from. So your interest rate is fixed, and oftentimes it's based on the Bank of England base rate. For example, the Bank of England base rate might be 5%. Your lender might give you 5.2%. And because it's fixed rates, you pay that interest rate over a specific period of time. In that instance, that means your mortgage rate is not going to increase nor reduce over this period of time. So either it's 2 years, as I said, or 5 years, or 10 years. Now, talking of variable rates, the difference between fixed rates and variable rates is the fact that it increases and decreases based on the Bank of England base rate. If the basic or the base rate of Bank of England goes up, that means the interest is going to go up. For example, if the base rate is 3%, according to the Bank of England, and your lender gives you a rate of 3.2%, if the base rate goes up to like 5, definitely your interest rate is going to go up to match the base rate of the Bank of England. So the disadvantage to that is if the interest rate of the Bank of England is increased over time, that means you end up paying a lot of money, or your mortgage is going to increase. Now, similar to the variable rate is the tracker rate. Now, the difference is that for variable rates, your lender sets what the interest rate is. They tell you, okay, let's pay 5.2%, let's pay 5%, depending on what the market is. In contrast, for tracker rates, the interest changes based on what the Bank of England sets it. So it is influenced by the Bank of England, not the lender itself, if you know what I mean. So it's kind of similar in the sense that tracker rate is a form of variable rate, in the sense that it changes over time depending on the interest. So if the interest goes down, you end up paying lesser amounts of interest, and if the interest goes up, of course, you're going to pay more. Now, the advantage of a fixed rate is that if you are able to fix your rate when the rate is low, that's good for you, because even if the interest rate goes up, which I think that is the situation at the minute, the interest rate is very high. For people that are fixed their rates, let's say less than 2%, they end up paying that particular amount of money over time. And it is when you want to remortgage, maybe at the end of your term, because when your mortgage term comes to an end, you need to remortgage. Like I said, if it's 2 years, 5 years, or 10 years that you fixed, at the end of this term, you tend to remortgage. And when you remortgage, depending on what the interest rate of the Bank of England is at the point, that is what influences the amount of money. So I've Some of my friends' rates have gone up drastically, the amount of money they pay every month. This is because the interest rate has gone up. So, as I said, fixed rates, variable rates, or tracker rates, you need to understand those terms and you need to decide which one is good for you. The next thing is you researching the market. When I say research the market, I mean you trying to get the best lender that would give you the best rates and the best amount of money required for your mortgage. For my own case, the first lender I went to was not able to give me the adequate amount of money required to buy the house that I wanted. So I had to find another lender, which oftentimes they have different things or different criteria that they look at to determine if or the amount of money they will give to you. So that would make me talk about the affordability check and the eligibility criteria. So talking of the eligibility criteria, so these are the things that they tend to look at before they decide the rate as well as the amount of money they can give to you for you to buy the property. So the first thing they look at is your credit score. Your credit score needs to be good, at least, for them to be able to consider you. There are some markets that they would tell you that if you come, we can, even if your credit score is bad, we can find a good deal for you. I mean, they might get it, but the interest rate which you tend to pay on these products will be very high. So it's just better that you build a good credit score so that you can have the best interest and have the best amount of money offered to you by lenders. Then the second thing they check is your income. Now, it is important that you are able to buy a property that you can afford, if that makes sense. So, for example, if you earn £70,000, you should be able to buy a property which you can comfortably pay your mortgage each month. So these are the things that banks will look at and say or determine if you should be able or you will be able to afford a property. Now, as a rule of thumb, they tend to multiply your basic or your gross income by 4. And that gives them a rough estimate of the amount of property or the type of property you should be able to afford. Also, there is an agreement in principle that lenders give to you to give you a rough estimate of the amount of or the type of house you can afford. So, for example, they might give you an agreement in principle and give you a particular amount, the maximum amount they can give or they can loan you as a mortgage. For example, they can give you a £300,000, and that gives you an idea of the kind of properties you should be looking at or where you should be looking at buying your property depending on the market. So it is very important that you research the market, get the best lender, get the best rates, check around, speak to an advisor, and that would help your decision. The next thing is what I call the 3 B's: bargain, bargain, and bargain. So when I first came into the UK, I used to think that prices of products are cast in stones. I was wrong. It was when I went to a car dealership with my friend, because my friend wanted to buy a car, and then we started talking about prices, and they were able to remove a particular amount of money. That was when it occurred to me, that you can actually bargain and cut down your cost. Similarly, one of my friends bought a house some years ago, and he explained or told me that when he wanted to buy his house, he was able to cut down the amount to a chunk of money, by a chunk of money. I was surprised, and this is because when I bought my own house, I bought it the exact amount or the same amount that was offered in the market. So that was why I felt I should let you know that it's important that you understand that you can actually bargain and cut down the cost of your house or of whichever property that you're trying to buy. Another thing that people tend to do also is ask for incentives. One of my friends, when he wanted to move in, he asked them, if you can't cut down price, what are other things that you can do for me? And they decided to do his lawn for free, the lawn in his garden. They did it for free. They offered to help him with movement or to move from his previous accommodation to his new home. So there are a lot of incentives in the market. Some even would give you a percentage and say, okay, because you are a key worker, we can give you 5%. Recently, we went to a builder, and they said they were going to give us 5% because we work in healthcare. We work in with the NHS. So it is important that you understand this. And when you go to your, to purchase that property, be ready to bargain, to talk about prices. Don't be afraid. They're not going to beat you. Ask for incentives, and it is one of these things that I felt I should have known. Also, you need to plan and budget for transitional costs. Now, aside the fact that you need some amount of money as a deposit, you also need to understand that by the time you move, you're going to start spending on some things, which could range from your furnitures, flooring, a number of things. Some houses don't come with flooring, and you have to pay to get it done. When you move into your house, you need to get an insurance. Almost everything in the house would need an insurance. For example, my boiler has an insurance, so you need a building insurance, you need an insurance for your gadgets. So these are the extra things that you have to pay for, and which should be included as part of your budget. Also, if you want to maybe upgrade your lawn, for example, you need to put that into consideration. For example, when I did my own lawn, I had to pay like 5,000, to change it from the normal grass to like an artificial lawn. So these were not part of what I planned as part of my moving into the house. So you need to understand that you have to spare some amount of money as part of your moving into the house. Lastly, you need to decide if buying a home is actually right for you. Now, as much as some people think that it's very important to buy a house, I think it is also very important that you decide if buying a house is for you, or if it is a good timing. For example, if you think you're not going to be in a particular location for a long time, I don't think it is financially reasonable to buy a house in that particular location. So even if it's within that country, if you're going to move, for example, you're moving up north from maybe southeast, and you want to buy a property, I don't think it is a very good decision, because by the time you decide to move, it's going to take some reasonable amount of months for you to sort out mortgage, sell the house, or do some other things before you move. So before you decide to buy a house, you need to know if the time is good. If you think you're going to be in that location for a long time, fair. If you think you're financially ready, or financially, of course, ready to buy that house, yeah, go for it. And guys, these are the few things I wish I'd known before I bought my first house. So if you have any questions, please feel free to drop in the comment sections. I will be, checking them out. I will be responding to them. And also, if you have any topic that you want me to talk about, please feel free to drop them in the comment section. Like, share, and if you haven't subscribed, please kindly subscribe. And I will see you in my next video.